All right, well, welcome back. And just want to go through a couple more subjects here. And we've talked about the issuing of bonds, and we've talked about the amortization of discounts or premiums when bonds are issued with a stated rate that's not equal to the effective rate. And when we've done that, we've done it with the effective method. And we also have to recognize that we can also do that with the straight line method, and we'll talk a little bit about that today when we do a problem. But our next subject is what happens if we reacquire debt prior to maturity. And so we know that if the debt runs all the way to maturity, we're going to amortize that discount or premium, and the credit balance and bond payable at the very end will be the face value, and then we'll just take it off the books. But if we reacquire debt prior to maturity, what do we have to do? Well, in this case, the most important thing is that the difference between the carrying value of the debt and the acquisition price is going to be a gain or loss. And it's going to be an ordinary gain or loss. There's no more extraordinary items. And what this requires, though, is that we have to have the carrying value on the date of reacquisition. And so this requires amortizing any discount or premium up to the reacquisition date, right? So you're going to have to pay interest from the time of the last interest date to the time of reacquisition. And that's going to be added to the cost of the bond reacquisition. And you're going to have to recognize interest expense for that period in which the bond was outstanding. The gain or loss from reacquisition is simply reported in income in the period of redemption as a regular gain or loss. So let's just do a simple problem with this, and this is going to be exercise 1412, and I'm going to add a blank sheet here. And when I look at exercise 1412, right, it tells us that we issued $1.5 million of 11% bonds, and these were issued at 98. So this is just another way of discussing bond prices without having to worry about, what the selling price is. So they were issued at 98% of par value. So when we take 98% times 1.5 million, we get $1,470,000. So they were issued at a discount of $30,000. And interest is paid semi-annually on June 30th and December 31st. The bonds had a 10-year life from the date of issue, and the company uses the straight line method for amortization. And we want to make sure that we can do this with the straight line method, and it's a much simpler method and allows us kind of do this problem for the reacquisition. So let's just think about the initial transaction, right? So when we do this, when we issued these bonds, we received cash of $1,470,000, and we had bonds payable of $1,500,000, and we had a discount on bonds payable of $30,000, and these were bonds that had a 10-year life, but they were semi-annual. And so in order to amortize that bond discount, we would amortize it over 20 interest periods. So let's just look at the T accounts here. Here's my bonds payable of 1.5 million. And here's my discount on bonds payable, and it's 30,000, and we would amortize that 30,000 over 10 years, but 2 periods, 20 periods, and so we would amortize $1,500 per period. And so to do straight line interest amortization, if we were thinking about that first date, and remember this was January 2nd, 2011. So, June 30th 2011, right, if we were thinking about the straight line amortization entry, right, we know that we'd have a discount, we'd have interest expense, we'd have the discount on bonds payable, that's the amortization, and then we have our cash that we would have to pay. And remember, the cash that we'd have to pay on these, because they were issued as $1.5 million of 11% bonds, right? So 1.5 million, and you remember the interest rate, the stated rate is 11%, but we have to divide it by 2. So the payment was $82,500. That was my cash interest, and I have a $1,500 amortization. And so when I did this, right, my interest expense per period is going to be $84,000. And right, so that's the big difference between the straight line method and the effective interest method, is that I'm solving for interest expense, whereas with the effective interest method, I'm solving for the amount of discount each period. And this would be the same journal entry every period. All right, every period would have this entry. And so that makes it a little bit easier to do this problem. And that what they tell us here is the bonds had a 10-year life, and they were issued in January 2nd, 2011. And they tell us on March 31st, 2014, Hill recalls the bonds at a call price of 107 plus accrued interest. So what we need to be able to figure out is what was the carrying value on that date. And so let's just kind of, I'm going to erase this June 30th entry, and let's just kind of think about what's happening here over that period. And I'm just going to draw a timeline to get us started here. And this is the date of issuance. Here's 2011, 2012, 2013. And remember, these bonds were repurchased on March 31st, 2014. So I'm just going to go here, and let's make sure that we have semi-annual interest dates. But remember that the reacquisition is on March 31st, 2014, and luckily that's 3 months or half of that period. So, you know, we have amortized 1, 2, 3, 4, 5, 6 periods, and the last time we paid interest is on December 31st, 2013. So just thinking about this, how many amortization entries have we done? We've done 6, so we've made, right, 6 amortizations of $1,500. And so if we thought about the carrying value, if we thought about the carrying value of these bonds on December 31st, 2013, right, it would have been $21,000, right? $21,000 discount, $1.5 million face value. And so what we need to do first is figure out how much interest has accrued from the last interest date up to the current date. And right, we remember we did the normal 6-month entry. Now we have to do, right, basically a 3-month entry. And so let's just kind of figure out what that would look like. And so on March 31st, when we reacquire these bonds, the first thing we have to do is we have to amortize the interest from the last interest date up until the date of purchase. And now I'm going to erase my timeline here. And just think, right, if I had a 6-month interest entry of interest expense $84,000, discount $1,500, cash $82,500, half of that would have been, right, on March 31st, interest expense, right, half of $84,000 or $42,000, discount $750, and right, I'd have to give the bondholders on that date half a period's interest, or $41,250. Okay. Let me just post that 750 here. So we know that the discount has a balance here of $20,250. And right, when I think about the total carrying value of those bonds on that date, the total carrying value is $1,479,750. All right, so the carrying value on the date of reacquisition after I've taken care of doing accrued interest is $1,479,750. And the big question is, how much should I pay to retire these bonds? Well, remember, I paid 107 plus accrued interest. So I paid 107% of the 1.5 million. So 1.07 times 1.5 million. I've already taken care of the accrued interest. This is the accrued interest, so I don't have to worry about that. So 1.07 times 1.5 million, right? I paid $1,605,000. So let's think about the journal entry here. If I paid cash of $1,605,000 and the bonds had a carrying value of $1,479,750, that sounds like a loss, right? And so let's kind of do the journal entry and see what that loss is. So the bonds payable would be 1.5 million. I have to get rid of the discounts, the remaining discount of 20,250, and the difference between those would be my loss, and that amount would be 125,250. The loss on reacquisition. $125,250. All right, so there's my loss on reacquisition. So, right, the reason we didn't use the effective interest method on this is, right, you'd have to kind of do all those calculations, and the straight line just makes it a little bit easier to kind of think about the concepts behind the problem. All right, so we should be able to do this, right? Big key here is making sure that you have the right carrying value on the date of reacquisition. So remember, those were callable bonds. The other type of bond that we had to worry about were convertible bonds, and that's where the bondholder, the creditor, can make a decision to convert the bonds into equity securities. So convertible bonds are securities that are initially liabilities, but provide the creditor the right to convert the securities into common stock. And so the big key here is at the date of issuance, there's going to be a case where there's a slight possibility. There's normally no recognition of the conversion option. If the bonds are converted into equity, the company should account for the conversion using the book value method. And what we mean by that is we remove the bonds and any related unamortized discount or premium and any unamortized bond issue costs, and we replace that with equity. And that's going to be the common stock or preferred stock. And then, right, the balancing entry part is going to be additional paid-in capital amounts. Now, there's a case, though, if any additional amounts are provided to induce conversion of the convertible's debt. So, for example, what happens is that the company really wants to get rid of these bonds, and so what they do is they decide to throw in some extra shares, or they decide to provide some cash. Any additional amounts to induce conversion by the bondholders should be recognized as an expense of the period. All right. And so let's take a look at exercise 17 here. And, well, before we do that, let's take a look at exercise 16, and then we'll take a look at exercise 17, which is an induced conversion. And I think what I'll do is I'll stop the video here and then start a new video with those exercises. Now, I want to get to the last little issue here. There are some cases where convertible bonds will require recognition of the conversion feature at the date of issuance. And those are convertible bonds that may be settled with cash payments in lieu of issuing stock. So if these convertible bonds allow for the company to simply pay cash instead of issuing equity, then the company has to recognize the equity conversion feature at the time that the bonds are sold. And the reason being is that normally these bonds are sold at significantly below market interest rates. And so what's going to require here is that you have to allocate a portion of that price that you received, that the cash received by the company, to equity. And it will show up as additional paid-in capital conversion feature. The amount that we allocate to equity is equal to the selling price of the bonds how much the company received minus the implicit value of the bonds when using an interest rate consistent with non-convertible bonds. So in this case, right, we know how much we received from the creditors. And now what we want to do is we want to price those bonds using an effective interest rate that was consistent with non-convertible bonds. And that difference is going to be the amount that we initially allocate to equity. And we'll do an exercise with that to show you how that works. All right. The last thing we want to do before we get into long-term notes payable is what happens if we issue bonds with stock warrants. And so stock warrants are certificates allowing the owner to acquire shares of stock at a certain price. And that price that you're able to buy the stock at is in a future date is called the exercise price. And usually it's within a stated period of time. So why do we issue bonds with stock warrants? So the bonds are issued with either bonds or preferred stock to make the security more attractive to investors. So normally these are high-risk companies, and in order to sell their bonds, right, they issue these stock warrants to provide additional value to the bond purchasers. Sometimes these are issued as evidence to existing shareholders of the preemptive right to purchase additional shares first. And sometimes they're issued to executives as part of a stock option plan. Now, the one that we're dealing with here is this first one. And so when bonds are issued with stock warrants, what happens is that you have to take some of that initial value and allocate it between the bonds and the stock warrants. Again, we'll do an exercise with that. All right, so I'm going to stop the video here, and what we'll do is we'll come back and we'll do some exercises.